In this video, we will be discussing different market regimes and how they can impact your algo trading. If you like this type of informative content, why don't you subscribe to the channel so you never miss another video? So, first of all, we can define what is a market regime. A market regime can really be classified as more of a longer-term market behavior. And if we look to the graph here to the right, we can see that regimes can include things such as the global financial crisis, the COVID pandemic, and effectively different types of market environment which have been caused by a certain fundamentally driven historical period in time. So a great example as well would be the 2000s tech bubble. That would be a huge, very bullish market regime where we saw the market continuously making higher highs and higher lows, and it was this incredibly strong bullish run. And then we can say, for instance, the 2008 global financial crisis, that would have been a very strong bearish regime, whereas the market sold off extremely strongly with various US financial institutions going bankrupt, and that was a very strong bearish regime. And ultimately, why this is important for algo trading is certain systems perform better in certain types of regimes. And certain types of market regimes can also cause certain algo trading EAs and bots to fail. So let's say, for instance, you have a long-only system. If you were to run it during the coronavirus crash, perhaps you would effectively be causing it would not do very well because it was primarily a bearish time. And one thing to note here is market regimes are generally fundamentally driven. These are long-term events which are happening, and sort of long-term periods when these regimes typically happen. And longer-term movements and longer-term types of markets are typically caused by some degree of fundamental trigger, right? Like over the long period of time, or a long period of times, technicals usually won't move price that heavily. What will move price is typically large fundamental events which are happening in the global economy. So, we can move forward now to discuss the three dominant types of market regime. We have a strong bull market, a strong bear market, and a choppy or more range-bound market. And to first look at a strong bull market, we can see here that we're continuously making higher highs and higher lows. The market is upsloping, and we see a really strong bullish sentiment. And this can be driven by certain fundamental events. This would be a great example of gold this past year. And as we know, with the interest rates globally coming down from relatively high levels in terms of recent history, gold has been starting to perform better and better because gold as a non-yielding asset does better when interest rates are lower. So in this rate cutting cycle, which has been starting to occur the majority of this year, we can now see gold continuously making higher highs. If we combine that with the global political instability and wars and whatnot, gold as a safe haven asset has just been surging enormously. Therefore, this year, running systems which tend to capitalize on long runs and bullish markets have been generally very profitable because they relate to this strong bullish market regime. We can now kind of go to the next slide, which looks at a strong bearish regime. This graph also relates to gold, but this was during the initial start of the C-19 pandemic, where we had an enormous sell-off in equity markets. And gold, as it's partially correlated to equity markets, we also saw this huge bearish push downwards. So once again, this shows that systems which may have been purely long focused would not have done super well in this environment. So a strong bearish regime would be characterized by lower lows, lower highs, and a strong down sloping price. And it's quite an interesting regime to trade as well. Now we can move here to a choppy market. And choppy, people tend to throw this term around quite a bit, but I would typically like to characterize it as more of a range-bound market. So we can see here, if we were to draw a support and resistance, effectively price is continuing to oscillate between those two levels and is making continuous local minimas and local maximas. And this is effectively when the market is waiting for a large fundamental trigger in order to create movement in a particular area. So this would be an example of 2023. This was peak C-19 pandemic, and people were effectively waiting to see what was going to happen. Federal reserves worldwide were just printing enormous amounts of cash, and there was a lot of speculation as to how this would cause inflation to move, and people were saying that, oh no, or central bankers were saying, oh, don't worry, inflation will be transitory because this is an unprecedented environment. But a lot of other people and traders were like, well, if you're printing trillions and trillions of dollars, most likely there will be some degree of inflation happening. And this uncertainty effectively was causing a range-bound environment in gold. And here, different trading systems than the first two regimes would likely have been most profitable, because we weren't seeing the same degree of violent breakouts either to the upside or the downside. It was more of a choppy, mean reverting environment. So really, to sum up these three large types of market regimes, they're clear, they're very obvious that these types of market environments happen. And there's a very, very clear fundamental reason as to why they happen. And the key takeaway from this first section is that different types of trading systems will perform better in these different market regimes. And now we can maybe dive into what those types of trading systems are. So here's an example of a mean reversion trading system from, it's just a diagram from Investopedia. And mean reversion, as the name would suggest, you are trading reversions to the mean. So effectively, when an asset becomes overbought, you would look to go short, and when it becomes oversold, you would look to go long. And this simply means that you are assuming that something has extended away from the mean, and it will go back towards the set mean. And this premise would be pretty terrible if you were in a strong bullish market, right? Because let's say gold is continuously making higher highs, higher highs, higher highs. If gold price goes to a higher high, this premise would tell you to short. But if you're in an incredibly strong bullish market, it makes sense that gold will statistically likely keep going higher. So you would lose money using this system. However, if you were in a range-bound market where price is oscillating between two levels, this may be absolutely perfect to trade. And the same logic can hold true if you are trading a trend-following system, and a trend-following system can be defined as trying to essentially take advantage of a long trending market and typically having a very high risk-reward ratio. And probably the most indicative example of this would be a moving average crossover, where you try to capture a large price movement. If you were to try and trade this in a choppy market, where you have a very, very, where you tend to be mean reverting, you wouldn't necessarily be able to capture these large price movements, and all of a sudden your risk-reward ratio would not be as good as what you expected. Therefore, trying to trade this type of system in more of a ranging market would not be ideal, because you would not see these long trends. Another great example here are breakout systems. Breakout systems, they are affected by market regime, but also by the volatility of the regime. So in the past few months, for instance, breakouts of support and resistance on gold have been slightly challenging because it's been relatively choppy due to US election data. So when price goes to a level, it tends to revert before going back above that level. Whereas in the spring, for instance, when we were in a continuous uptrend, if price were to reach a level, it would quite often break through it and continue going further. So this goes to show that based on the market regime, you are able to apply different types of trading systems. So something which can be very useful to trading a portfolio of algos is perhaps you can also apply a market regime filter to your broader portfolio, so you're able to decide which bots to trade depending on the general market conditions. So this is a wrap-up of our presentation today. I hope you found that useful. And if you'd be interested in learning more about us here at Prosperity Algo Solutions, I invite you to go click our link in bio for the WAP page where you can trial any of our bots as well as receive the free Golden Time Bomb bot. Thank you very much and hope you have a great day.